Hi all, and welcome to the 14th lecture on Austrian School of Economics. And the topic of today is credit and banking. So, the reference book is Principles of Economics of Safedin Amos. And let's start with discussing about banking. We start with a quote from Ludwig von Mises who wrote, "Every kind of human arrangement is connected in some way or other with money payments. And, therefore, if you destroy the monetary system of a country or of the whole world, you are destroying much more than simply one aspect. When you destroy the monetary system, you are destroying in some regards the basic of all interhuman relations. If one talks of money, one talks about a field in which governments were doing the worst thing which could be done, destroying the market, destroying human corporation, destroying all peaceful relations between men. Banking is the industry that specializes in the management of money, as we all know, and it has two essential functions: managing deposits and investments. With the division of labor occurring on a large interpersonal scale and the use of money as a common medium of exchange and saving, the banking industry increases the productivity of saving and investment, allowing for greater capital accumulation and higher productivity. Members from society benefit from others lowering their time preference also in this way. That is to say, others people's savings increase the productivity of your labor. In fact, the first job of banking is to help savers maintain the wealth they accrued and protect it from thefts and ruin. As individuals' homes are optimized for location, comfort, and other characteristics, they are not optimizing for resisting thefts. An increasingly specialized economy will provide individuals and firms with the opportunity to store their wealth in facilities specializing in secure storage. Banks, in fact, would accept deposit and charge their owners a fee for the privilege of using facilities. Bank owners finance the construction and operation of safe facilities that are less likely to be robbed than individual homes or workplace. In its basic form, when done safely, sanely, and honestly, deposit banking is a boring and largely uninteresting market good that does not merit much economic analysis. It is only when deposit banking is abused that the interesting and tragic consequences unfold, and this we will discuss about it in the next chapters. And now we discuss about the credit, so the commodity and circulation credit. The second function of banks is to invest the savings from customers in pursuit of profit that increase them while taking the risk of losing them. By abstaining from consuming and by abstaining from saving money, the saver becomes an investor and he makes his savings available to purchase inputs of a production process. Where a capitalist lends his own money to an entrepreneur, a bank lends the money of savers, effectively specializing in the allocation of investment while leaving the savings to specialize in whatever it is that earns their income. The task of bankers is to act as the intermediary between the saver and the entrepreneur. And there are two kinds of credits: commodity credit and circulation credit. Commodity credit is a credit which is borrowed by banks and granted by entrepreneurs, making banks mere intermediates profiting from the difference between the interest rate they pay their lenders and the rate they charge their borrowers. It is important that the quantity of the credit that the bank extends does not exceed the quantity of savings that savers have lent to the bank. It is a very important point. Should there be a discrepancy between the quantity of credit the bank borrows and the quantity it lends, or should there be a discrepancy between the maturity dates, then the bank is not longer engaged in lending of commodity credit, but in circulation credit. In this case, the bank is not merely transferring the money of savers to entrepreneurs, but it is issuing a credit that is being used as money, effectively inflating the money supply. The distinguishing feature of commodity credit is that it involves a sacrifice on the part of the lender. Someone has to forego access to monetary instruments equal to the full value of the loan for its entire duration in order to the loan to be issued. The lender forgoes the money in the present in the expectation of receiving a larger payout in the future. The borrower, on the other hand, gains access to the money in the present but pays an added cost when repaying the loan. The interest rate at which the loan takes place illustrates the differing valuation places on time by each party. The lender in fact has a lower time preference, while the borrower has a higher time preference. With the difference in time preference between the two is what creates the opportunity for them to agree on an exchange. There is not such a thing as a prevalent market interest rate, only individual interest rates, because value is subjective, which are affected, these interest rates are affected by the individual projects and the individuals involved. And now we move to interest rates. In a free market economy, the interest rates will be determined by people's time preference. What determines which projects are funded and which are not is not their time productivity, but the availability of capital, which is a function of time preference. Time preference makes the capital available. Entrepreneurial judgment attempts to allocate it to the projects with the highest expected returns. The ratio of the value assigned to a present good is called the originary interest, and time preference is what creates the phenomenon of originary interest. Assuming the currency value remaining constant, a person who is owed a payment of $100 today will need to be offered a premium on it in order to delay accepting the payment by a year. Hope describes the market determined interest rate as the aggregate sum of all individual time preference rate, reflecting the social rate of time preference and equilibrating social savings and social investment. The demand for investing and purchasing capital goods is practically infinite, and the limiting factor on the quantity of investment is the quantity of cash saved. Time preference determines the quantity of loanable funds, which will then go to fund the projects with the highest expected returns, whose borrowers are willing to pay the highest interest rates. The more funds are saved, the lower the interest rate, the more projects can be funded, and the lower the expected rate of return on the marginal product. And by deferring consumption to provide capital for investors, the capitalist incurs the cost of the operation in terms of time. The capitalist invests the time in the enterprise by sacrificing present goods for future goods. The entrepreneur uses the resources and sacrifice of the capitalist to pay for the workers, landowners, and capital goods sellers in the present. The process of production takes place over time, and the entrepreneur sells the final goods. Only then, if the capitalist pay, they agree upon interest rate. Only at that point the capitalists get paid. If the revenue from selling the final output of the production process exceed the costs paid to the providers of the labor, land, capital, and time, the business is profitable. In the market of capital, individuals have value scales ranking present goods against future goods. Present goods are more valuable than identical future goods because time preference is positive. Humans effectively place a discount in future goods. If a personal discount rate is higher than the market interest rate, she will demand to borrow from the market, since she will value the repayment of the principal in the present. If her personal discount rate is lower than that of the market, she would lend her cash saving on the capital market, as she will value the repayment of the principal and interest higher than holding the present cash savings. At the capital market level, all of the individual time preference and money demand and supply curves are effectively aggregated into economy-wide supply and demand curves or loanable funds. At any given interest rate, there is a total amount of capital that is available for lending and demanded for borrowing. Since the capital available for lending increases as interest rates rise, while the capital demanded for borrowing decrease, This is as interest rate rise. The two quantities must only meet once, as the interest rate which clears the market capital, where the quantity of loans is equal to the quantity of capital saved from consumption and made available to borrowers. As capital is allocated to economic production, productivity increases and income rises. With secure property rights and increased certainty of the future, time preference will be expected to continue to decline further, making individuals more likely to defer consumption, more likely to save, more likely to lend, and less likely to borrow. The abundance of loanable funds allow for the financing of an increasing number of productive enterprises at progressively lower interest rate. Unless interrupted by war, pestilence, degradation, or regular burden of centralized governments or imposed easy fiat money, this virtuous cycle of improving material well-being continues, which can be understood as the process of civilization, a known topic we have seen in the previous lecture. And now we go on trying to answer the question, can interest be eliminated? From the Austrian perspective, interest is not an alien invention imposed on society by leaders, but like all economic phenomena, interest has its root in human action and in the time preference that is positive for each individual. Attempting to abolish interest will not lead to elimination of interest rate lending and will instead lead to the consumption of capital stock, as savers have less of an incentive to preserve their capital when they cannot make a return of it. Capital owners will find themselves with a stringent incentive to consume their capital stock. It hurts society overall by reducing the incentive to save and thus resulting in capital accumulation. So a society without interest lending is less productive, less innovative and less prosperous. The 5,000 years trend of lowering interest rates discussed in the previous lecture was reversed in the 20th century, so in the last century, because the move to fiat money likely played a major role in this shift. And decline in time preference increases the abundance of capital, and the abundance grows the price of capital as interest decline. A continuously advancing civilization would witness its time preference decline, leading to more future provision and more moral concern for future generations, which results in capital being widely abundant. As people own larger quantities of capital, the demand for borrowing declines as well. At a sufficient level of abundance, the return of lending becomes lower than the cost of carrying the money, at which point a borrower can secure a loan from the many lenders available by simply promising to pay it back in full, because he will be saving the lender the cost of storage and insurance of the risk of theft or loss. That will be the ultimate case. And now we discuss about the 4 key points before closing the lecture. First is that banking is the industry that specializes in the management of money, and it has 2 essential functions: bank deposits and investments. The second function, investment, is investing the savings from customer in pursuit of profit that increase them while taking the risk of losing them. There are commodity credit and there are circulation credit. And then the circle or the process of civilization, so productivity increases, time preference decrease, we have more savings. This triggers further lower interest rate, then productivity increases even more. And this is the vicious circle of process of civilization. Last but not least, a continuously advancing civilization will witness its time preference decline, leading to more future provision and more moral concern for future generation, with the results in capital be widely abundant. And with that, we have finished the lecture on credit and banking, and see you in one of the next lectures. Bye.